Good evening. I'd like to call to order the January 24, 2023 regular Finance Committee meeting. Would you please call roll?
Chairman Reinhardt,
Here.
Vice Chairman Hoagland,
Present.
Member Streeter,
Here.
Member Brooks,
Here.
Member Iglesias.
Any word from Iglesias?
No, no word yet.
All right. First things to order, if you have a chance, I'll give you a few minutes if you haven't read it already, the minutes from the October 25th, 2022 regular meeting. Give you a couple minutes to review it if you haven't already. If everyone's had an opportunity to read it, Chair will take a motion.
I motion that we accept it.
A recommendation for approval. Do I have a second?
Second.
Second, all in favor, say aye.
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 All right, passes unanimously.
I just mentioned, thank you so much for the detail and all of the work in putting this together. Appreciate it.
All right, I'm looking, I don't see anything previous business, so current business, we're gonna go with Jeff.
Okay, good evening. Welcome to our first quarter budget report for fiscal year 2022-2023. So this is as of December 31st, 2022. Again, the purpose of this presentation is to present highlights of the City of St. Cloud first quarter budget report. The report presents an overview of the city's revenues, expenditures, and key department statistics for the fiscal year, and the reported period is October 1st, 2022 to December 31st, 2022. And these are unaudited as of January the 18th, 2023. Okay, we'll review over our top 10 revenues. Of course, our biggest revenue source is ad valorem revenues. Through December 31st, we had collected 80.9% of our total budget. And actually, as of today, we're up to 92%. So we're doing well in that regard. We get we normally get about 80% in December, and then another 8 to 10%, and then we get another percent or two in the following months. Impact fees, 12.4%. So that is down because the building activity is down. So single-family permits for the first quarter were, we had 53 in October, only 19 in November, and 26 in December. And we've been as high as 150 or more in a month in the past. So we're way down in our building fund, and of course, impact fees all roll into that. So all of our impact fees, police, fire, mobility, parks, they're all impacted by the recent decrease in building activity. Probably been about 4 or 5 months now that it's been down. Hopefully that doesn't last, but kind of went along with rising mortgage rates, and the cost of building materials, you know, has just decreased the number of buyers, so it's decreased the building activity. St. Cloud, OUC Interlocal, that's funds we get from OUC each month, so we're right at 25% because it's an agreed upon amount from year to year, so it's a lot. And now we actually have the same thing as we get down there with Toho. 1% sales tax. It is only at 7.2%, but that is only 1 month. $500,000 that's just 1 month because it kind of runs behind and because of the holidays. So we're up.
Is that the tax on the delivery, Amazon deliveries and so forth?
No, that is a 1% statewide sales tax that is passed along to the municipalities. So we're on track to, because we get a payment each month of, it's been $500,000 or more, plus we get one per quarter, a quarterly payment as well, which runs in the $350,000 range. So I would estimate we exceed $7 million pretty easily in that account, which that account we use for vehicle replacements. We use for like the new fire station. Large capital items is what it's supposed to be used for. So like next year, we'll be using about $5 million towards the new fire station 35 out of that 1% money. Refuse service fees, that's the sanitation fund. That is showing at 0. Toho is collecting on our behalf since it's part of the water bill. The process hasn't been fine-tuned yet as to how to get those funds best to us. So they owe us a lot of money. So it's forthcoming, and even as of today, we still don't have those. But they're coming. 1/2-cent sales tax, we're at 18%. That is 2 months' worth, so we're right on track with that one. The public service utility taxes, those are like taxes on your cell phone bill and your electric bill. They're only at about 18%, but they generally run lower in the winter. So when your electric bills go up in the summer, our collections into this account also go up. So that's where you'll see this generally lag a little bit behind percentage-wise. St. Cloud Toho Interlocal, that is our new fund, which collects the 12% that we receive on the Toho water and sewer sales. We actually did receive $825,000 last week, so it's reflecting 0 because this is as of 12/31, but we did get our first payment of that, which is good. Stormwater service fees, they're the same as the refuse service fees. They're collected as part of the water bill, so we have not received those as of yet. And county gas taxes are at only 8.7%, but that's only 1 month. So generally, we run only 1 month behind, but because of the holidays and whatnot, they were slower in getting us our funding.
Jeffrey, I just want to go back just real quick, just for curiosity's sake, with the impact fees and the lack of construction. Have we placed or thought of what we're going to do with, from positioning to how we're going to allocate when we got money not coming in? If we're averaging, say, at 100 homes and we're in the 20s and 30s. That's significant. And where are we looking at offset that for those divisions that are impacted by that?
Well, fortunately, all the impact fee funds have a healthy fund balance at this point. So the only fund that we've had to make immediate adjustments to is the building permit fund. We've had to freeze staffing. We've changed a couple staff members from charging them to the building fund to charging them to the general fund. So we've had to make accommodations there, but fortunately, Parks Impact, Police Impact, Fire Impact fees, and mobility fees are all have a healthy fund balance. So it's more longer term, but if growth slows down, then the need for additional fire stations and police, new police officers and roads lessens. So at this point, we're okay in the short term. Now, if it went on longer term, we would be faced with some issues potentially.
What do you consider longer term?
I would say 3 to 5 years. If we had 3+ years of the current level of building activity, then we would start having issues in the impact fees. We wouldn't be able to build, say, a new fire station other than the one that's currently in progress, which is Fire Station 35. So if things didn't improve, and we don't have any immediate, there he is right there.
Hello, this is Scott Stitcher calling in from PFM Asset Management. I'm a little late to the meeting, but I think they would still like me to present this evening.
Yeah, hi Scott, this is Donna. Can we put you on hold just for a little bit until you're ready?
Absolutely.
Thank you so much.
You're welcome.
Okay.
So anyway, Parks Impact Fee, they have a large fund balance of nearly $10 million, so there's not any immediate concern there. Police Impact Fees, we don't have any immediate plans for those. The fund balance is around $4 million. Fire Impact Fees, after Fire Station 35 is constructed, we don't have a lot of those left, so that could present funding issues for what is planned to be Fire Station 32 replacement. And mobility fees, we have about $10 million worth of fund balance. We do have a number of projects already in the works. Again, it's longer term. The longer term potential impact would be that we would have to cut down on the number of projects. So roads, parks, fire stations.
The divisions that do inspections and things like that, when I don't, say we have 10 people that help with inspections and now we're only doing 30 compared to 150. What are we doing with that staffing to,
Yep, that is
I don't want to be
why
firing people, but are we like, hey, how would you like to work over here at Parks and Rec? Or, I don't know how it is number-wise. I'm just curious what we're doing if it's a continuing trend.
we haven't got to that point yet. And it has been determined that the general fund should pay a portion of the atrium costs, which were 100% funded by the building fund. So part of budget amendment number 2 in March is going to be transferring $1,018,000 from the general fund to the building permit fund. So it pays for its fair share of that building, because that building is going to serve as the entrance for both buildings after it becomes fully operational. So that building is not 100% like occupied and used by the building department people. So that'll give us a little bit of leeway there. As I mentioned, we did take 2 fire inspectors that were, one was fully paid and one was partially paid by the building permit fund, and we did move them to the fire department. So, and there's been, in essence, a hiring freeze in the building department, so we're not replacing any staff or hiring any new ones at this time.
Have you noticed the difference in, like the infrastructure sales tax of 1%, a little higher because of the increase of building materials and stuff? Or have you, or is it kind of minuscule?
That fund has been steadily increasing over the almost 3 years that I've been here, and it's just spending in the community. So the more houses that are here, the more people spend in the immediate area, and the more that we get. Like just a couple years ago, Tohoku was not much, and it's a lot now. So you add new houses and new residents, and they spend money at restaurants, gas stations, and Walmart and whatnot, and that's where we get increases there. Because it was 2 years ago, it was about $5 million. So we've steadily increased in there, and I believe we'll continue to do so, although maybe at a smaller rate. Like next year, I would expect maybe we go to 7.5 million instead of what we've been going at, probably a 8% increase per year. I do not believe we'll increase that for next year just because our number of new homes has subsided. Any other questions on this slide?
No, sir.
Okay, these are the major fund revenues. General fund has collected 37.4% of the estimated $63.2 million. Again, that's number is higher than the 25% we would generally expect because of the ad valorem revenue mostly being collected in December. The sanitation fund, as I mentioned, has not received their funding, their revenue for their residential and commercial customers since Toho is collecting that on our behalf. And the building fund, we would hope that they were at 25%, but they're only at 17%. So that's a pretty good reflection of the revenue loss as just a result of slower building. You know, we estimated their revenue at nearly $4.3 million, and through December 31st, they've only collected $730,000. So, but as we discussed, they've cut expenditures to the point that later on here, we'll see that they're breaking even. They're not like increasing their fund balance, but they're not eating into it either. And stormwater fund, they've collected virtually nothing, again, because Toho is collecting those for us, and we've not been in receipt of those revenues just yet.
Do you have a
Is
date
there,
for that?
We do not have an exact date for that. I was hoping it was this month, and still hoping it's this month, but this month is running out. I think it's supposed to be soon. We just don't have an exact date, so, because they owe us a couple $1 million anyway. Next is the major fund expenditures. The general fund 15.5 million or 23.7% of the budget. Now this does include encumbrances, so encumbrances are basically purchase orders which has reserved money, but the funding is not actually left the building yet, so to speak. Sanitation fund, they've obligated and expended 52% of their budget, but a large portion of, like, they encumber their landfill cost for the whole fiscal year. So all that's already included in there, so that's why it's showing a little bit higher than you would expect. The building fund is at 46.2%. The major reason for that is because of that $3.3 million, approximately $2.5 million is the new atrium. We still have approximately $2.5 million to pay for the completion of that. So that's where most of their expenditures come from, and the rest of it is mainly staffing, salary, and benefits. And the stormwater fund has expended / encumbered 28% of their budget thus far. So they're about right where they should be. Any questions on those? This is the major fund surplus deficit that I alluded to. So the general fund, and this is excluding encumbrances. So this is basically money in the doors and out minus money out the door. So the general fund has added to its fund balance by $10 million. That's because of the ad valorem taxes. So from this point forward through the rest of the year, we will likely be spending on a monthly basis more than we're taking in the general fund. Just an average payroll for the city is near $1.5 million for salary and benefits, and that's twice per month, every other week. So sanitation fund is showing that they've lost $1.2 million. Again, their revenue is only partial because their residential revenue is not included in there. And here's a good reflection of what I spoke of. The building fund is just actual funding in revenues in and out. They've lost $2,891 since October 1st, which finance is happy with because they're not losing a significant amount of money thus far. So they're breaking even, and they're not really there to make large sums of money. They're there to support ongoing building permit operations. So, and this does not include that $1,018,000 that I spoke of that's going to be transferred to them as part of budget amendment number 2 on March 9th. And the stormwater fund is, of course, showing in the negative, again, because their revenues are incomplete until we get the payment from Toho. Any questions on this one? And here's your departmental breakdown by in the general fund. So we would expect to want to see about 23 to 25%. If we're spending at the rate that we should be. So City Council has spent 30% of theirs. City Manager and Public Information only 18.5%.
Jeffrey, why don't we just focus on 30% or above?
Okay. Legal Services is 53.2%. That's because we encumber the legal services contract. So our legal services are under contract, not as a staff member, so that's why that is so high. And actually, there's no other ones over 30. There's a few that are like a little bit under where they should be, like code enforcement, but their overall budget is insignificant. But bottom line, total expenditures, we've spent 15.6 66.7 million out of 65.4 million, or 24%. So we're actually right on track where we would want to be. You know, we truly don't want to spend all of our budgeted funding, because if we do that, then we have no prior year fund balance to pull from in the forthcoming year to balance our budget. So, you know, we want to be efficient, but if we're too efficient, then, you know, we could run ourselves short in the following year. Any questions on any of these? Any specific department?
Nope, I think everything sounded pretty good.
Yep, that's it. Yeah, we're in good financial condition at this point. Just watching the building activity. It has improved. Talking to the deputy building department director this morning, I believe building permits through last week were up to 41, which is still not a lot, but it's better than the 16 or 20 that we had in previous months. So, you know, we would prefer to get up to around 75 or more in a month. That's probably our best break-even point. So other than that, everything else is proceeding. Projects are going along. Hopefully we'll have the atrium done in the next couple months or so. I'm not the project manager, so I don't know, but it's making progress. So without further ado, we'll get to PFM.
Get Scott back on the phone.
I think he's been with us all.
Good evening. I'm
that's-
here.
Okay. All right, Scott, ball's in your court now. We'll go with you.
Okay. I apologize again for being a little bit tardy, but I'm glad we were able to connect, and glad to have the opportunity to review our quarterly presentation with you. My understanding is you have like a 10-page board report in front of you that I'll be working from. I just want to confirm everybody has that.
No, Scott, we have the full version.
You have the full version?
Yes,
Okay.
50 pages.
All right.
I don't think hey, Scott, I don't think we need to go through 51 pages worth of material.
No. No.
Give it to us
I'll
in
tell
10
you what
minutes.
I'll do. I will definitely do a condensed, abbreviated report here.
Thank you.
So I will stop briefly just to paint a backdrop of the fourth quarter, looking at page 4. I'll just, again, at a high level, the economy can be characterized by signs of slowing inflation, and that has been, seen by not only the Fed but the markets as a real positive. We continue to see a very strong labor market, but as a result of the signs of slowing inflation, has allowed the Fed to wrap up what we're saying here is the normalization process. So basically what that means is they're slowing their pace of rate hikes. It appears as though the meet here at the end of the month and first day into February, the markets really feel as though the Fed will only raise rates by about 25 basis points at that particular meeting. So what has that meant? Well, the markets have been considerably less volatile, and we've seen, as we see here in the first bullet on the bottom of the page, we've seen Treasury yields in the belly of the curve, that 3 to 7 year space, slightly lower. And as you know, with fixed income, lower yields, lower interest rates mean higher bond prices. So falling rates are a good thing. The shorter end of the curve, the longer end of the curve still saw rates going higher. But for this portfolio, we tend to be in that belly of the curve. Or we tend to be purchasing securities in that 3 to 5 year part of the curve. Now, keep in mind, too, where we're in a little different situation in this portfolio in that we are allowing maturities to remain in cash. We're building up cash in anticipation of a portion of this portfolio transitioning to the Toho Water Authority. So that buildup in cash has caused the duration of this portfolio to shorten considerably, and that benefited the portfolio in the third quarter when interest rates rose dramatically, but it also hurt it a little bit during the fourth quarter. Not dramatically, but the cash balance, the shorter duration, definitely held performance back a little bit during the fourth quarter. We'll see that here in a second when we get to the performance slide. Let me fast forward to slide 20, 21, and 2022. I want to make sure we point out that these are what I refer to as our compliance slides. So I want to point out that you are in compliance with the investment policy set by the city. There's no concerns here. We look on page 20 at the sector breakdown. The gray outline bar is the again, the amount permitted by policy per sector. The maximum amount, I should say, permitted by policy. And the blue represents the actual allocation to that particular sector. So you can see this is, I always use the analogy of a gas gauge. This is one case where you don't want a full tank of gas. You want the ability to be nimble within your portfolio and amongst your sector allocations. And so, again, you're in compliance and there's no real issues from that standpoint. Page 21 looks at the max allowable, max maturity, maximum amount allowable per sector. Again, the gray bars represent the policy limit. The blue bar represents the actual allocation, or in this case, actual limit, maturity, I should say, by sector. And again, you don't have any issues from an investment policy standpoint. Page 22 just gets into a little more detail. It is an issuer diversification slide. So it takes a little deeper dive at the sector level to see the individual issuers that make up that particular sector. Your policy, in most cases, does not allow more than 5% per issuer. It really depends upon the sector. Obviously, the Treasury is a different beast. But as far as corporates are concerned, you're not going to see, or an asset-backed securities, you're not going to see an allocation greater than 5% there. And again, this slide points out that you're in compliance with that limitation set by your policy, and you're in compliance from a credit quality standpoint across all the holdings as well. I think it's always important to note that you're in compliance with the policy. Fast forwarding to page 24 is an overview of the portfolio. We have a number of statistics here, from credit quality to sector breakdown to a duration distribution. But the upper left-hand corner is where I'm going to focus first. You'll note the total market value of $153,636,120 at the end of the fourth quarter. You'll also note that cash buildup that I referred to earlier, $11,598,585. And again, we anticipate the cash balance to get up to approximately $28 million through the next 3 quarters. That's just through maturities that are going to occur in the portfolio. And the majority of that is going to occur during the fourth quarter, which the quarter that just ended, December 31st, 2022, and the first quarter of 2023. About $23 million of that $28 million will occur in those 2 quarters. So you're going to continue to see the duration, which is a risk measure of the interest rate sensitivity of your portfolio. You're going to continue to see that number fall as the cash builds up relative to the benchmark. And unfortunately, the yield at cost is probably not going to adjust as quickly as it would have if we were reinvesting those maturities into higher yielding securities. So for the time being, the statistics of this portfolio are going to be a little bit wonky until that cash leaves and we continue to manage the city's portfolio relative to its original mandate. And that will happen down the road here soon enough. But it's just important to note that it's still a very high credit quality portfolio at AA. It is still somewhat diversified with the majority of it in Treasury, so very safe, very liquid, and again, diversified for the most part. So let's look at performance. And before I get into performance, let me just take a breath and just see if there's any questions. I've thrown a lot at you in a short amount of time. Any questions on the backdrop or the compliance slides that I've shared with you?
What would it take to get us to a AAA rating for the quality of it?
It would be for the S&P to upgrade the U.S. Treasury debt, outstanding debt. That's really the holdup. If we were to use Moody's statistics, it would be AAA. But we're looking at we utilize S&P statistics in this particular report, and S&P downgraded U.S. debt. Gosh, I think it was back in 2017-18 time period to AA+, and that's really what really sways the overall portfolio credit quality to AA.
Thank you.
Fair enough?
Thank you.
Yeah, you're welcome.
Has there been
Anything else?
Has there been discussions about what you're going to do with the cash equity that comes in the next couple months? Or is it just...
It is going to remain. It is going to remain in cash again until that transfer to Toho takes place. So it will remain technically, I'm going to say uninvested, but it is sitting in a money market fund sweep vehicle. But we are not going to be buying individual fixed income securities until a later date.
Thanks.
Yeah, as I mentioned, what we'll end up doing is in the next couple months, we'll take a good portion of that available cash and make another transfer to Toho. We owe them somewhere in the neighborhood of $50 million more. So as our portfolio is generating more cash from investments maturing, we'll in turn transfer that to Toho until they're paid in full, so to speak, and then we'll go back to normal investment operations, as he mentioned, the original intent of the portfolio at that time.
Yeah. Thank you. So let's look at page 28. It's really, I'm fairly certain what you're most interested in seeing. I mentioned earlier that interest rates did fall along the belly of the curve, that 3 to 7 year part of the curve. And lo and behold, what you see for the 3 months ending December 31st are positive returns. I think you have to go back to over a year ago before you would have seen positive returns in a quarter for fixed income portfolio. That interest rates have done nothing but go up from that period forward and have risen dramatically over that time period as well. So it's kind of nice to be able to deliver a positive return to our clients. The portfolio was up 0.89% for the quarter versus the benchmark at 0.95%. You take out the fees in this portfolio, and that puts the net of fee return at about 0.87%. So we did slightly underperform the benchmark, but again, I point you to the fact that the cash balance in the portfolio was a little bit of a drag on the overall return of the portfolio. But hopefully, the positive return eases the underperformance a little bit. Vice versa, in the looking at the full year, that cash balance and the shorter duration of the portfolio actually worked in the city's favor. The portfolio was only down about 4.22% versus benchmark that was down a negative 5.25%. Net of fees, that equates to a portfolio return of negative 4.29, negative 4.29%. So almost 100 basis points of outperformance relative to the benchmark over the past 12 months. So again, this cash transitioning to Toho actually worked in the city's favor to some degree. The cash balance as well as the shorter duration that comes along with holding cash, again, worked in its favor over the last 12 months, relative to the benchmark. So let me stop there again, just see if there are any answers with regard to performance.
There's no questions.
Okay. That's about all I had as far as prepared remarks. Again, I know there's a lot of pages in this book. Is there any place in particular you would like me to go or go into more depth on?
We see the inflation numbers continuing to go down. Do you see that moving into 23? A continued reduction of
We do think that we're starting to see the fruits of the Fed's labor, and we do anticipate that interest rates inflation will continue to fall, but it is still very elevated. So I think we are in a little different camp than what the market is in regard to when the Fed may begin to cut interest rates because of the slowing economy. But we don't think that will happen in 23 because there's still a long way for inflation to go to get back to normal levels for the Fed. So we think we'll see interest rates higher for longer than what the market is sort of anticipating here. But we do think we've seen the worst of things from an inflation standpoint.
So you see the Fed increasing rates 1 or 2 more times?
We do. We think they've been pretty transparent in their need to do so. So I think you're looking at a minimum of a rate hike here at the end of the month, and then another 25 basis points in March, and then I think they potentially could pause just to continue to monitor inflation data and the jobs market, which are the Fed's 2 main mandates.
Yeah.
So smaller hikes, but hikes nonetheless.
Any other questions?
No.
All right, Scott, that seems to be all for the questions.
Okay. Well, thank you for the questions, and thank you for your time. I'm glad we were able to catch up.
Thank you again.
Thank you.
Thank you, Scott.
Okay. You're welcome.
All right.
Take care.
All right, other business. Our next meeting is Tuesday, April 25th. It'll be our second quarterly meeting. Does anybody have any business or questions?
I was just going to ask a quick question that on our minutes that there is a suggestion that the information officer show how this penny sales tax will be of a benefit to the city, and if there's been anything done yet to be promoting the passage of that.
We talked about putting signs out to let people know
Yeah.
what that tax was for.
I can't answer that question. That's more of a city manager question, so we can pass that on to her and see if we can get some additional information on what their plans are.
Okay.
Any other questions?
No, I think that. Nope, nope.
And again, if you have any questions between meetings or any additional information that you want to see during the meetings, by all means, just let me know, and we can give you whatever you think will be beneficial.
Thank you.
All right,
How's Fire Station 35 coming along? Is it pretty good?
It's still in the engineering stage. It's not, even to the bid stage quite yet. We would expect to probably, hopefully, put it out for bid in the fall.
Well, so that's gonna be a couple of years down the road before it actually opens then.
Yes, however, they are planning on opening a temporary fire station in the same area. They purchased a temporary building, I guess, so it will be in the same general area as the permanent station. So there will be something there, hopefully, within the next 12 months, I would hope.
All right, we have no audience in attendance. If there is nothing else, meeting adjourned.
Thank you.
Thanks.